Hello and welcome back to the Commodities Institute podcast. I am your host, Emily Costa, and it is Wednesday, February 11th, 2026. We have everything from precious metals defying industrial gravity to a complete credibility crisis in agricultural reporting. There is a lot to unpack, so let us jump right in. We have to start today with the precious metals sector, specifically the silver market, which is telling a fascinating and somewhat contradictory story. Today, silver rallied 3%, pushing above $83 per ounce. Now, if you have been following the markets this year, you know we have seen silver touch some incredible highs, even briefly breaching that psychologically heavy $100 mark back in January. While it has retraced since then, the fundamentals are incredibly constructive. What makes this interesting is the bifurcation we are seeing in demand. On one hand, industrial demand for silver is actually looking a bit soft. In the solar industry, which has traditionally been a massive consumer of silver for photovoltaics, we are seeing manufacturers aggressively shifting toward cheaper substitutes. However, the investment side is more than making up for it. The Silver Institute is forecasting that physical investment will jump 20% this year to a 3-year high of 227 million ounces. Investors are clearly looking for a hedge against macroeconomic uncertainty and geopolitical tension. Even with the industrial cooling, the market is facing its 6th consecutive year of a structural supply-demand imbalance. We are looking at a supply deficit that could widen to 67 million ounces in 2026. It is a classic case where the physical reality of a shortage is finally catching up with the paper price. Speaking of institutional realities, we have to talk about the bombshell coming out of the United States Department of Agriculture. There is a growing storm regarding the department's credibility after it issued massive revisions to the 2025 corn harvested area. We are talking about an increase of nearly 5 million acres that seemingly appeared out of thin air in the final reports. This has absolutely rocked the trust that farmers and traders place in these monthly figures. The root of the problem appears to be internal. There has been a significant loss of experienced staff and a general decline in morale that observers trace back to the restructuring during the previous administration. When the data is this volatile, it makes it nearly impossible for farmers to make informed decisions about their planting for the coming season. For 2026, we are already expecting corn planting to drop by about 4 million acres as farmers struggle with high supply and suppressed prices. If you cannot trust the baseline numbers from the government, the risk profile of every hedge and every seed purchase goes through the roof. While the US is dealing with data drama, the situation in South America is shifting in a way that would have been unthinkable just a few months ago. The US Treasury Department just issued a general license to facilitate oil and gas exploration and production in Venezuela. This is a massive step following the capture of President Nicolas Maduro in early January. Washington is clearly moving to reintegrate Venezuelan crude into the global market to help stabilize prices. The US Energy Information Administration suggests that Venezuelan production could see a 20% increase in the coming months, which is significant given they are currently hovering around 1 million barrels per day. But it is not all smooth sailing. There is a fascinating internal conflict brewing in Washington between the Treasury and the State Department over the sale of Citgo, the US-based refiner. The State Department wants to move forward with a sale to help settle billions in claims against Venezuela, but the Treasury has frozen the process, likely to maintain some political leverage over the new transitional government in Caracas. For the drillers, this new license is the green light they have been waiting for to bring in specialized equipment and rigs that have been barred for years. Turning our eyes toward Europe, the energy story is taking a turn that many did not anticipate. While the European Union reported back in October that gas storage was over 80% full, the actual winter conditions are testing that resilience. We are seeing exceptionally low snow cover across the Alps and southern Europe. This might sound like a niche weather concern, but for the energy markets, it is a disaster. Low snow means low meltwater, which translates to a significant drop in hydropower availability for the spring and summer. In response, we are seeing utilities burn more natural gas to make up the difference. European natural gas prices have been volatile, spiking recently to nearly €42 per megawatt hour before easing back. Even though the continent is working hard to phase out Russian gas entirely by 2027, the reliance on liquefied natural gas imports is reaching new all-time highs. We are expecting LNG imports to rise 7% this year. It is a reminder that even with a massive push toward renewables, the weather still dictates the bottom line for energy consumption. In the world of industrial metals, copper is facing its own supply-side squeeze. Codelco, the Chilean state mining giant, is still reeling from the seismic events and accidents at the Teniente mine late last year. Output there dropped 13% in 2025, and the latest projections suggest that production will remain depressed for at least another 5 years. This is a huge blow to the global copper supply at a time when data centers and the electric vehicle transition are hungry for the red metal. When the world's largest producer is struggling with these kinds of structural setbacks, it creates a floor for prices that is very hard for bears to break through. We're also seeing a major shift in the coal markets, particularly out of China. The China Coal Transportation and Distribution Association just lowered its import forecast for 2026 to 465 million tons. At the same time, China is ramping up its domestic production to a record 4.86 billion tons. They are trying to insulate themselves from the volatility of the international market, especially after Indonesia, the world's largest exporter of thermal coal, restricted shipments to support prices. It is a bit of a tug-of-war. China is launching more than 100 new coal-fired power generators this year to meet the surging demand from AI data centers and electric vehicles. But they want to fuel those plants with their own coal rather than relying on expensive imports. Finally, a quick look at agriculture in Europe. In France, the Agriculture Ministry has actually raised its estimates for winter rapeseed and soft wheat planting. The autumn weather was incredibly favourable, allowing farmers to get into the fields more effectively than in previous years. Rapeseed area is expected to be about 8% above the 2025 level, as farmers are lured by better prices compared to cereals. It is a rare bit of stability in a global grain market that feels increasingly uncertain. As we wrap up today's episode, it is clear that the old rules of commodities trading are being rewritten. Whether it is the impact of AI on energy demand, the political reshuffling of South American oil, or the breakdown of institutional data in the US, the theme of 2026 is adaptation. We are moving away from a world of predictable cycles and into one defined by structural shifts and unexpected volatility. I hope this deep dive helps you navigate the complex landscape of the markets today. There is always a story behind the numbers, and finding that narrative is what keeps us ahead of the curve. If you have found this episode valuable, be sure to subscribe, share, and leave a review. This has been Emily Costa with the Commodities Institute podcast. I will see you back here tomorrow for more analysis of the world in flux.